Afternoon. My name is Greg Leffel. I'm with the Virginia Blockchain Council. I help lead our initiatives as it relates to advocacy, community building, and really education. And that's kind of what today's about, right? Super excited to have our guest here. We're excited to have you here and our folks that are viewing online. Want to say thank you to Fairfax County EDA, Fairfax County Pension Funds, Bitwise. Ben, thank you. I know you came a ways. And obviously our friends over at the Chamber of Digital Commerce. Appreciate all the work that you all do on a daily basis to continue to move our industry forward. Certainly it's an interesting time as it relates to the industry. All I can say is we're early in our journey, and that's kind of our mantra as a council. And with that, without further ado, I'm just going to kick it over to Toby.
Yeah, great. Thanks, Greg. Yeah, echoing Greg's comments, thank you all for being here. Thanks for everyone dialing in. My name is Toby McComas. I lead the development and member services team at the Chamber of Digital Commerce. We are a DC-based policy and advocacy shop representing companies in the digital asset and blockchain space. Really excited to have the folks from Pension as well as Bitwise here today to kind of talk through certainly recent events, but also kind of longer term and pick their brains on their experiences in the space. So with that, I'll ask Ben and Katherine and Andy to come up and we'll go ahead and get started. All right, I think it probably makes sense for introduction. So why don't we just go right down the line here? Katherine, start with you, if you wouldn't mind introducing yourself and kind of what your role is at the pension.
Sure. It's a pleasure to be here today. So thank you, everyone and the sponsors. My name is Katherine Molnar, and I'm the Chief Investment Officer of the Fairfax County Police Officers Retirement System. It is roughly about $1.7 billion.
My name is Vincent Molino. I'm the head of operations and diligence at Bitwise Asset Management. A little bit about our firm. We are a digital asset and crypto asset management company around since 2017. We predominantly manage index portfolios, and we also recently started active fund management.
Andy Spellar, Chief Investment Officer for the Fairfax County Employees Retirement System, which nowadays is about $4.5 million. And we're different investments since 2018 in the investment in the crypto space, or we like to call it digital asset space. But and we are also just full disclosure shareholders at Bitwise through one of the venture capital funds.
Thank you. All right. Well, obviously there was some pretty major events in the space last week. We certainly will address that gorilla in the room, but I don't want this to turn into an FTX conversation. Just to kind of start, Katherine and Andy, for you all, when and why did you begin to kind of explore crypto as an investment option? What was the original thesis? You all were obviously very early mover kind of this traditional capital into the space. So it'd be interesting to kind of hear what your thoughts on this.
So we started this journey in 2018. So I guess probably 4.5 years ago at this point. And to be honest, it all started with we were attending a conference, and it was not a crypto conference. It was a conference of with a lot of institutional investors there, and it was led by a consultant. And there was a gentleman who was an academic who spoke on the topic of blockchain technology. And at the time, we didn't have a lot of we weren't terribly familiar with blockchain or Bitcoin or, quite frankly, anything really at that time. But we were really intrigued by what he had to say. And as an academic and not representing an investment manager, with no disrespect to Bitwise, but he effectively kind of had no skin in the game, if you will. So to us, he was somebody who was, an objective third party, if you will. And so about a month later, when we came back from that conference, we were approached by a manager, and we knew the organization already, but we'd never met with this manager. And it was a venture capital blockchain technology fund. And, because what we'd heard a month earlier, we were super intrigued about the topic. And so we started really looking into it and doing due diligence on the area, and really just considered it to be a really high growth area. And so we made that initial investment, both of our systems. So Andy and I worked closely together. And that was approved by our boards of trustees in 2018. Again, it was a venture capital manager, and I could talk more about what we've done since then, but in essence, we've both made 9 investments so far in the space. Starting out in venture capital, and again, in that sense, we weren't trying to make a bet on Bitcoin, or actually, quite frankly, any of the layer ones, or even less necessarily like an individual protocol, but rather the technology infrastructure that underlies blockchain technology itself. And for us, it became part of a broader innovation theme in our portfolio. So that innovation theme for us in both of our systems is made up of blockchain technology, life sciences, artificial intelligence, cyber and national security technologies. And I have a 5th vertical in mind, which is
I'll just add to that. So the professor was Campbell Harvey. He was pretty well known sort of finance guy out of the academic academy, investment world, and well published, very well respected in a lot of different investment topics. So he had a lot of credibility in terms of that initial presentation there, because we didn't know. I mean, it was a Ponzi scheme, right? We didn't know anything, right? And so, but it was very clear that there's a lot of technology that's underlying this. And the more that we delve into that, you just think about where we're going to be going. So, 5, 10, 15, 20 years from now, will more things be digitized or less? And the answer is obvious, right? And so it seems to us that blockchain technology is one of the things that's going to facilitate that. And certainly in the world of finance, there's just tons of applications for it, right? It's right for the problem. And we have a lot of exposure to those legacy businesses that, so from our perspective, if you didn't have exposure to this, you were shorted. Right? And so, we start out very small. We've tried to be, very judicious in the way that we go about it. We understand it's controversial, but that's a lot of the noise that fits that. Right? And things like this week don't help, obviously, but it doesn't change the underlying investment thesis for us. Like I said, we sort of built out a venture capital sleeve that's based in 4 different sort of almost some of them are interconnected. So artificial intelligence that plays a role in blockchain, life sciences, and cybersecurity, and lots of things like that, national security. So there's a lot of tie in there, and if you can just sort of put, and what we were able to do is just sort of put the noise to one side and just really try to get behind the Bitcoin loudspeaker, and that's really what.
Yeah, and I presume this is not a trading strategy, right? This is a very long-term kind of secular.
Yeah, we can address that a little later. If some other questions, but
Katherine, I've had the pleasure of sitting in the audience for these presentations that you've done before, and I know you've done quite a few of them. You can do this in your sleep. Was there I think you mentioned this, but maybe talk about kind of the underfunded component to making this decision and kind of making up on gains where you were lagging.
Sure. So our pension systems are underfunded. That's pretty typical in the public pension space, sadly. Very, very few public pensions in the US are at the surplus level. Our pensions are not horribly underfunded though, so like in the 80th percentile, which is above the national average. But nevertheless, and if you can kind of back up 4 years ago, we were at a time, coming off of just extraordinary gains, if you will, in most risk assets, so equities and credit, and things had gone really well for really long, and that's all well and good. But when you're in an environment like that, your expectation of future excess return over cash ought to be moderated, right? And it was for us. And so we have a 6.75% actual assumed rate of return for all 3 of our systems. And if you did the math, and if you only were going to just be in the public market alone and not use any leverage, it was really hard to get to 6.75% if you were looking at future expected return, not what had happened in the past, but in the future. And so, and that math really didn't work unless you wanted to kind of go all in on like emerging market equities. We're not going to do anything like that. So we had already, before these blockchain investments, we'd already been moving over time a little bit out of private markets and into public markets and trying to hopefully earn a higher return, and admittedly taking out an illiquidity, but hopefully there's an illiquidity premium and a fee premium and all things that go along with private investments. And so again, this was an area that we thought of as like just high growth, and venture capital, particularly the high growth in anybody's portfolio. And so that's how we approached it, that we recognized that we probably couldn't get to 6.75% in the public markets alone. And so this was just, again, part of being willing to, do something that we thought was extremely high growth. And then, you obviously tried to kind of diversify that with something else that's going to have an opposite, profile. But so that was a little bit of, also the
Yeah, it's just part of a broader theme where we've gotten more private, and this is a small part of that. But we've also done that in private credit space, and then also in real assets. And we own all kinds of really off the wall things, like we're in cattle feedlots, we own rail cars, we own grain elevators, very physical things that throw off cash, right? And so one of the concepts was, on those kinds of investments, we wanted to get closer to the actual cash flows and capture them, not have to deal with the volatility and the forward-looking expected returns of public markets, right? And then on the venture side, the private equity side, it's a bifurcated structure as well. So we have a certain number of investments that go out and actually buy stakes in private equity firms, which is a very lucrative business, right? And so then we're collecting the high fees that everybody complains about. Then on this other piece, which is sized appropriately, we're willing to take, because we've got so many diversifying aspects to it, we can take a little bit more risk on the venture side, hit these niche areas, right? And go into smaller segments of the market where, the opportunity is tremendous. There's risk in the volatility around it, but, in the overall portfolio structure, it makes a lot of sense.
Okay, well, we made it about 6 or 7 minutes without talking about risks. So here we go. Ben, why don't you take a crack at this one? Can you help kind of explain some of the risks that exist in investing in this space versus more traditional vehicles?
Yeah, I'll try to pick examples that aren't obvious for the past week. Some things that we need to consider with regard to crypto investment risk management are first and foremost the technology. These are very new technologies that a lot of people are not familiar with. And so I think it's really incumbent upon anyone that's investing in the industry, whether it's us or pensions, to really consider, one, how the technology is being developed, who owns the technology, who owns the intellectual property to that, and more importantly, what are the cybersecurity risks related to that? As we know, there's been plenty of examples of that. The other things I would say that are risks specific to the industry is the fact that most of these technologies are owned by emerging firms, emerging companies that they themselves don't really have a certain level of maturity with regard to running a business. Again, we could use the past week as an example of that. But it's really incumbent upon us as an investment community to help basically create a level of maturity and institutionalization with regard to these crypto firms, to help them become really mature businesses at the end of the day and reduce the risk to us as investors. The other thing I'll add too, though, is that the old rules still apply. And I know you said you don't want to bring up FTX, but I think it's a good reference point. Basic things such as conducting very rudimentary due diligence. Do you have an audit firm? Who is the audit firm? Who are your counterparties? What is it like to deal with you? Do you have good references? These are all important things that I think, quite candidly, some people got caught up in the hype over the past few years and forgot the basics to doing this. And so we have to apply the old rules to the new rules I mentioned before, and I think that will lead to success.
Katherine, maybe you do that from kind of a high-level risk standpoint.
So I suspect that Ben will probably come on to this point, so I don't want to steal his thunder, but I think also from a operation diligence perspective, there are differences in this area versus other assets, and as it relates to custody of tokens and certain organizations that have to self-custody tokens for a certain period of time. So as an investor, you have to get comfortable that you have a manager that is self-custodying some of their assets. And if it were like any other type of investment, that would just be a huge red flag. That's like the last thing you want to see. And then, in our particular case, so, if we can get comfortable why a manager needs to self-custody for a certain period of time and that they have the, security protocols in place to do that. One of our investments, it's one of our venture capital investments, the manager, we were able to get comfortable why they had to self-custody. At a certain point, they made the custody assets external to an external service provider. Great. Well, in that particular case, that manager owned that service provider, right? That was one of their portfolio companies from one of their prior funds. So you would, in any other space, I would never invest in a manager that owns their own service provider. It is the potential for conflict of interest is there, and it's not insignificant. And so, what I guess the way I've kind of told other people is that I would never suggest that somebody suspend their judgment ever. In this space, I would just tell people that you have to be a little bit open-minded because it is still fairly new. That means a lot of the service providers, I know the managers new, the technology is new, a lot of the service providers are new. I mean, the whole ecosystem is new, right? And so, the auditors maybe, there may be, the auditor of one of the funds you're looking at, you may have never heard of that auditor before, right? And if any other kind of area, you probably wouldn't invest with a manager who had an auditor that you've never heard of before, right? So, and quite frankly, when we were looking at this space 4 years ago, we weren't terribly familiar with these custodians either. And now you have other people like, Fidelity is willing to custody, tokens, and stodgy BNY Mellon, I shouldn't say that. Yeah, BNY Mellon is willing to custody. Sorry. But you know what I mean? Like these organizations were not household names that, like the Anchorage Digitals and other people that so anyway, I just, I think we all need to be open-minded and it is still fairly new. But there are definitely issues specific to this area that you just don't find in other parts of
that system is growing. So now there's auditors now for investment managers that provide that service. There's specialized in that area right now. So where we are now back to where we were 4 years ago, there's been a steady ramp up of things that from a traditional perspective, much more operating.
Yeah, absolutely. I would agree with that. So, you've seen very traditional Wall Street or institutional type names that have been in the capital markets financial services space for hundreds of years, building digital asset practices today. And so, whether that's a Deloitte or an Accenture or somebody else, that they are developing expertise in this space and are heavily involved. All right, well, let's stay on the FTX thing for a minute. Ben, can I ask you to maybe, I'm going to go off script here. I don't want to put you spotlight on you.
I love
Do you mind
improv.
kind of explaining maybe at a high level kind of what went down and how we wound up in the condition we're in right now?
I'm going to qualify my response by saying we're all still figuring out what's going on.
Absolutely.
Based on what I know so far. So 2 things. One, massive conflict of interest, where essentially the exchange part of the house was exchanging with the investment part of the house. So that's FTX and Alameda. If I could draw upon a classic example that a lot of people know is Bernie Madoff. That was one of the issues there, is that Bernie had his own broker dealer, which he was creating trades or transacting with the other side of the house, which was asset management. And that led to issues that we're starting to see today. Second issue, as I mentioned before, Katherine mentioned this too, is it's still to be known specifically who the audit firm or firms were that were working on this. I know some names were put out there, but it doesn't seem like that whoever was the auditor was doing their fiduciary responsibility in order to keep an eye on all the books and records. The third issue, I think, was hubris, for sure. I think that things got as bad as they did, and we could use Madoff as another example of that, because there are a lot of people that might have known better as investors or counterparties or the people that were dealing with that organization, where they weren't liking what they saw, but they still went ahead and did business with them, and weren't pushing back when things seemed odd. And then the other thing I would say too, that was probably one of the most significant issues, and a lot of this is kind of the elephant in the room too, is the lack of regulation. They were an offshore-based organization. There is a competitor that's out there that's US based. I think a lot of you probably know what I'm talking about there, where, I don't want to say they did it the right way, but they did it a way that is regulated, that kind of conformed to the norm of providing a sense of level of security of holding client assets, where a lot of people, again, chose to roll the dice and go with an offshore jurisdiction, and specifically an offshore company, and now they're dealing with the fallout.
Yeah, thank you. Yeah, I mean, I think at a high level, it was a classic kind of run on the bank. Despite FTX being, an exchange, very different than the regulation point there, where they hold those deposits. You don't hear about a run on NASDAQ or NYSE here. You hear about Cody Crunches and runs on banks. So that being the key thing. And I think your point about parallels to traditional capital markets, financial services. We see these scams and fraudsters historically, right? It's not a blockchain or a crypto specific thing. There are bad people out there regardless of whether they're not, in the crypto or blockchain space at all. So thanks again for kind of highlighting those points. So, with the risks that you all highlighted, understanding what happened last week, how on earth did you get your trustees comfortable with the risk that was associated here, right? Like, crypto was for drug dealers and you had the Mount Gox thing, money laundering. Like, how on earth did you get a pension group of pension trustees comfortable?
Yeah, and I would tell you, this was not too long after I think the Mount Gox had, had issue had taken place. Well, there were definitely concerns. I managed to get money for police officers, right? And there were definitely concerns about, is this, money laundering? Is this, a place where nefarious actors, are playing? I think it went a long way when we went on site to do the due diligence visit with the manager in the summer of 2018. It wasn't just the research team that went, everyone from the investment team went, including even our executive director. We had people from operations there, and some of them were, there remotely. We took some trustees from each of our different boards, and that really went a long way because it wasn't just that this is a new manager, as it would be, any other time you bring in a new manager, but for, it was a new space, a new strategy, if you will. And we really wanted them to get comfortable. We really wanted them to hear directly from the manager. And so they were in front of the manager, like we were 4 hours on site at the manager's offices. And so I think that went a long way, when ultimately when the manager came to present to our respective boards for approval. I mean, it wasn't unanimous. And I mean, I did have people who voted against it who were concerned. But on the whole, I think that people recognize that that it's, an area that's likely to have massive growth. And I think that, I think Andy and I don't know what's for everybody on our boards, but I think some of us at least have really bought into the notion that we really do think over time that, virtually everything, will be digitized eventually, every asset, every bond, every mortgage, right? And, we'll vote on blockchain someday, right? And, your passport, your driver's license, I mean, your medical records, right? I mean, everything, everything, but yeah, a lot, right? And so we believe that that we're headed that way over time. And again, it was a long-term investment, as you said. At least initially, we can come on to what we've done more recently, because some of the more recent ones are very different than venture capital, but at least that was the original thesis, and that's how we got it.
Yes. So this wasn't a bet on blockchain or some protocol. It was a bet on a secular shift to the use of the technology across.
It wasn't a bet on
any industry, any sector, etc.
And I think the manager and ultimately us were able to convey that to our trustees. That's the objective, right? It's not about Bitcoin or anything like that. And so, but we are very lucky in that we do have a program where we take our trustees out on due diligence trips with us to go visit managers. And so, some people do that, but not a lot. I think it's pretty unique. And so they get to travel with us to, say, New York, to do a full day of meetings with different strategies, different firms, different perspectives, different arguments about the same topic. And so they really get to hear a lot of things. And that's been a big part of our success, I think, just in general. We have a pretty good return. And so I think the boards generally have, they don't just hear from us once a month at a board meeting, right? We get them out on the road, hearing different things, perspectives. And I think that was really the key, right? Because a lot of these people had heard this a couple times before it even came to the boardroom. Whereas, some other places you get a 25-minute pitch from the manager and then a recommendation. That's it. And that's the end of the dialogues.
Yeah, you're just scratching the surface. Perfect. All right, Ben, as an asset manager, kind of exclusively committed to the digital asset space, can you tell us a little bit how Bitwise thinks about introducing new strategies or different strategies within the space?
Yeah, sure. So, first and foremost, like I said, we had started off essentially as an index fund where we were putting together portfolios to kind of capture the space in large, whether it was specific, digital currencies, Bitcoin and Ethereum, and since branching off to other companies that actually invest in the space, being an ETF product that we have now, so actually owning securities. I can tell you from the active management side that it's a pretty thorough process with regard to how we put together the portfolio. and we think about this stuff. First and foremost, my colleague and my partner, Jeff Park, who is the portfolio manager for the active management side, really has been involved in this space for a very long time. He knows a lot of the key players going back to really almost the early to mid 2000s. He himself has personally invested, as many people in the industry have, but developed that into an actual process and thesis that he brought to a professional state at his former firm and here now. You know, when Jeff and I have conversations about the firms that we're looking at and the underlying crypto portfolio managers, there's a few things we take into consideration. One is, what is their area of expertise? Within the crypto investment space, you have a broad range, as Katherine and Andy said before, that you could look at more liquid venture capital investing that seemed to be the trend for the past few years, but now an actual subcurrent of various trading strategies that you would have seen in the past are occurring now, market neutral, relative value. And then there's also managers that are just long bias that again are investing in technologies, but maybe with some hedge around that. When Jeff is looking at those portfolio managers and he's considering how we put together our portfolio, that's really where I step in, where I begin to evaluate the investment firms themselves. So let me just take a step back and explain what operational due diligence is for those of you that might not be aware. I'm essentially evaluating the business risk of the investment manager or the organization itself. I'm taking a top-down approach, looking at the organization, who owns it, who runs it, what their staffing is like, where they're located, like I mentioned before. And then I kind of draw it down further into, do they conform to any type of compliance? So that's obviously based on the type of firm that they are or where essentially they're based regionally or geographically. Then I look at true operations. And I will say that when it comes to crypto, you know, this is a different area for most of us that come from the traditional finance world, where we're used to dealing with, let's say, investment managers or traders that are essentially using order management systems to book a trade like a security or some kind of fixed income instrument. As I mentioned before, a lot of these guys are developing their own technology. And when we take it a level deeper, and this is not to pitch us, just to explain our process, we have to understand, as I mentioned before, what is this technology they're developing? Is it their own intellectual property? And more importantly, how does it function, right? And the last part there is, what are the controls and safeguards against that? Because if they're actually going into an actual blockchain, if they're going into the actual ecosystem, they could expose themselves to potential risks. After that, we look at who are their counterparties. So again, the example that we mentioned before, who are you trading with? Who are you holding assets with in custody? Katherine brought up a great point before that there's this bit of a debate now from the old traditional finance world, where of course you would always custody your assets with the big well-known banks. But to Katherine's point, some of these assets can't be custodied anywhere because the banks just don't have the infrastructure to do that, or regulation to prevent them from doing that. Last thing, just to round out the other things that we look at too, is we look at the actual fund structures that we're going to invest in themselves, meaning what is the governance there? Does it have a board of directors? Has this thing been in existence long enough that it actually has an audit where we could also contact their service providers? And probably something else that we do too, which is something somewhat simple, but I think some people forgot in the recent example over the past few weeks, is we also conduct background checks. We want to know who these individuals are in addition to references. So that's the process that comes together with how we form our portfolio. And then to answer your question about how we come up with different products, well, it's really driven by two things. One, what is the opportunity? So like I said, right now we have the opportunity to invest in many different areas. And then also the other thing that drives that too is what are our clients looking for, and can we help put that together?
Perfect. You know, kind of keep going on from that. So what are some of the most common questions that you are getting from potential investors looking to get exposure?
So I probably say,
I guess, as they diligence you.
yeah, for sure. I would say a few common questions are, as I mentioned before, what is your investment thesis? What is your strategy? How are you essentially going to figure out a way to invest capital and provide a return? That's more on my portfolio manager side. For me, the questions are a lot of what I talked about before, which is, do you know and do you understand the organizations for which you're investing? And more importantly, what are the risks there? The other element I would add to that I think a lot of clients, and I know both people on the side of me have asked this question too, is when you find a risk, what do you do about it? See, that's the difference. We're not just saying that there is a risk and that we're going to accept it. What we do is try to be as proactive as possible to work with the investment managers almost in a consultative type of manner, where we not only identify the operational risk issues, but work with them to improve it. So examples given before is, you're working with an unknown, unreputable auditor. We found issues in the past. We would like you to change the audit firm or else we will not invest. Your fund structure is not making sense. There's no governance or no independence in terms of board of directors or other types of third parties that could say whether or not they agree with the valuations of the assets in the portfolio or how operations are being conducted. We look for that too. And another example here, as probably the best example, is more importantly, a lot of these organizations sit right outside the realm of regulation right now and compliance. And so a lot of them will say, okay, we understand that maybe you're not hitting the threshold to be regulated by the SEC or some other global financial regulator, but we'd like you to implement guardrails, compliance guardrails and policies in place that will be part of your day-to-day functions in order for us to feel comfortable with how this place operates.
Thank you.
I just might sort of add on to that. I mean, my understanding is from Bitwise's perspective, they have exposure to FTX. And I would like to just sort of get that out there that from our perspective, we have no direct exposure to FTX, credit of our managers. And the due diligence process that they've gone through, a number of them were offered opportunities to invest in FTX. One passed up 3 times, one passed up six times, right? So we don't, we feel like, there's a lot of serious people like Ben out there really digging into, things and there were some warning signs out there, not only just for FTX, but some of the, the Luna sort of things that were going on for a while. There was quite a bit of knowledge out there, including the folks that we've been working with. So, so we have no direct exposure to FTX. There's a minimal exposure in one fund where one of the underlying funds has, but in terms of the impact on our portfolio, we've not had any, at this moment, the best that we have a knowledge of and the assurances we've got for managers, we don't have any exposure.
So you all have slept well.
I don't know about slept well.
All right, well, that's a great segue into kind of the next question I have. And I'd like to drill into the portfolio a little bit. If you can maybe highlight some of the investments that you've made in kind of the digital asset crypto space, which I mentioned.
So as I mentioned earlier, we've both made 9 investments to date. And again, it started out venture capital, and most of them are in fact indeed venture capital. And so we've been very happy with that, even despite the crypto winter, for the most part, those have done very well on the whole. And then more recently, about a year ago, we made our first hedge fund investment in the digital asset space. And we found it to be pretty interesting. So it's, it's an absolute return. It's a multi-strategy manager, all digital assets. And some of the strategies are directional momentum strategies, but then a number of them are these relative value arbitrage type strategies that Ben had mentioned. And so very kind of classic hedge fund strategies, very classic like hedge fund relative value arbitrage strategies. So they are doing things like basis trading. They're doing yield farming, which is where you lend or provide liquidity to an exchange and you earn a yield in return for that. They're doing things like cross-exchange arbitrage. They're doing things like trust arbitrage. So very kind of typical, my background is I came from a hedge fund allocator role where I spent more than a decade. So as soon as this manager started talking about, and I guess let me just back up, like up to that point, we'd met some hedge funds in the digital asset space. Most of them were loan only. So most of them were just buying tokens, right? And there's nothing wrong with that, but we didn't necessarily need that exposure that, we didn't need that. We already had, plenty of exposure we thought. So, but on the other hand, this hedge fund, which is long and short, and so they're not 100% net long, although they are typically net long, but not 100%. And they, we thought did a very good job of really varying their beta over time. And it's not beta to equities, which is what we usually think of when we think of hedge funds and what's your beta to equity, but rather beta to crypto itself. And so we really liked this idea. And we thought that this space, there's a couple of things that made it particularly interesting in our opinion. Number one, it's still very new. So it's a very nascent space, which means it's typically very inefficient. And these types of trading strategies and alpha hedge fund strategies, as we all would know, would do very well when things are inefficient. So some of the strategies that I mentioned before, there's hardly any arb left on any classic hedge fund. Like if you tried to do cross-exchange arbitrage in the equity space, there's hardly any arb there left, right? I mean, there probably hasn't been a lot of arb in that strategy in like 15 years. But in the digital asset space, like there's, arguably, and Ben may disagree, or Brian from Bitwise might disagree, but in general, like, we can all say that there's probably less efficiencies. But the other thing that is actually makes this space or lends the other reason it lends itself, well to these arbitrage type strategies is because of the volatility itself. Now, a lot of people are scared away by volatility. We think that's probably keeping some institutional investors kind of on the sidelines, though it's a volatile area. It is a volatile area, so you need to size it appropriately, which we think that we did. But in a hedge fund construct, in particular relative value construct, volatility is like the single greatest. It's like literally the single greatest component that you could have for relative value strategy. Like probably that is like the single best thing you could have for relative value strategy. So the volatility that's inherent in this space, instead of it being a negative, can actually be, maybe a positive for this type of strategy. So at any rate, we invested in the hedge fund. And so, that's an absolute return strategy. And then more recently this summer, we made our first allocations to yield farming. And we did that at the time as a replacement to high yield. Now, these strategies were approved in May. And so I'm telling people that because, yields weren't as high in May as they are today. So at the time in May, when we were, had gotten this approved by our respective boards of trustees, we considered it to be a high yield replacement. It had a more attractive yield than high yield. It had almost a very, very low duration. The duration of these loans, again, this is lending to exchanges and earning a yield in return. The duration of these loans is literally 1 week to 3 months. So very, very low duration and over collateralized as well. And so, again, and not taking any crypto price risk, by the way, because they're typically lending in dollars. So it's not a bet on, Bitcoin or Ethereum or any other, layer one or any other token, because they're typically lending in dollars. And they're typically facing the exchanges themselves. So they're not lending directly to crypto miners. So they're from a counterparty credit perspective, they're facing just these exchanges. And believe me, we've had conversations with these exchanges in the last week, but trying to be sure that these are well-capitalized institutions and all the things that one would hit for. So anyway, so that was, a high replacement. And the reason I mention this to people is because, depending on what we're talking about defines where it resides in our portfolio. So most of the exposure to the venture capital is in our equity bucket, right? It's a growth exposure. The hedge fund is our hedge fund bucket. It's an arbitrage strategy. It's not super directional. And then finally, yield farming is a fixed income replacement. And so that has a different risk profile again. So all three of these, differ from each other. They play a different role. They have a different risk profile than each other. But that's what we then take.
Just adding on to sort of, the big picture is the approach that we take actually at Fairfax is a little different. We start with risk, and in fact, where a lot of people sort of build a portfolio and the risk is just all out of that, right? So everything is sized in our portfolio relative to its risk contribution. And that drives then how the sizing relative to what we want that risk contribution to be. We have a healthy respect for the volatility of the asset class, right? So when we first got into this, like you said, we consider this to be an equity space in terms of venture capital investments. It's technology to us, nothing different. And so, when we looked at it and got into our first investment was on a $5 million fund was $10 million. Right? So now that had an outsized return. So it grew as a part of our portfolio. That's a first world problem, right? That's a kind of a problem that you might want to have, but and that presents some challenges in of itself. But in terms of the initial capital that we put at risk, has been, I think, very judicious in the way that we've gone about it. Now we've had some outsized returns, but so everything is driven that way. So when we look at the venture capital, we have a risk echo for that, and that drives the size. Hedge fund, we have volatility estimate for that as well. It's our smallest position, right? And then even just we feel very comfortable, and the return so far on our yield farming has been incredibly stable all the way through this whole period. So we feel pretty comfortable about that. But again, it's sized appropriately within our portfolio, so that we're not taking outsized risks. And that's just the way that we operate to begin with, right? That's our beginning point, not the ending.
That's great. You kind of answered some of the ones in the next question was asked, but I guess has your allocation to kind of yield farming component changed based on a better high yield environment? I guess my question is, just because it's approved doesn't mean you have to do it, right? It's just kind of another arrow in the quiver to drive returns. So, and then maybe leading into, how do you think about rebalancing and as you manage the overall exposure?
First question, and I'll let you. It's a rebalancing was, that's a challenge at the minute. Yeah, so it's a great point. So do we still need to be in it, you know, yields have come up from the high yield space and is it still as attractive as it was on a relative basis? I mean, a couple things to note. Number one, in the case of those two organizations, we entered into multi-year revenue sharing agreements with both of those organizations, whereby we were willing to basically help them seed these strategies. I mean, they'd already been, I should say to back up, they'd already been doing these strategies, help them seed a fund. They'd already been managing these strategies, help them seed a standalone vehicle. And in the process, lock our money up for 3 years to provide that seed capital. And in exchange for that, get a 10-year revenue share with these organizations. So no, we're not pulling out of it. But it is, I think, just important to note. So the time these got approved, which was in May, and then they were due to get funded over the summer, and we did fund them. I mean, it wasn't even that much money relative to some of the other allocations that we've done, but we still chose to fund it over a 3-month time period. We also we kind of wanted to leg into these, if you will. But it was right around the time that the whole Terra Luna debacle was taking place, right? And you know, 3 years capital and all of that. And although we still liked the strategy, we still very much like yield farming, but we wanted to be sure, quite frankly, that these organizations, that these managers were basically going to provide liquidity to these exchanges, were still going to be around, you know, in a month or, you know, whatever. And so we got on the, and so we talked to the managers before we funded, you know, before we actually put the money in, but we actually reached out and talked to the heads of risk management of each of the organizations that were counterparties for these funds, because we also wanted to talk directly to the counterparties of the funds and really be sure that this wasn't a systemic problem, if you will, you know, within kind of the digital asset space. And so, because even to your point, these have been approved, we didn't necessarily have to fund it if we thought that, you know, something was about to go very south. So so we try to be opportunistic in this particular case. We're not gonna, you know, we're not gonna pull out of it immediately, but
and Katherine just touched on one thing that you know, the due diligence process for us and the learning process for us is not stopping. So I will tell you that we've just really, we understand what we've gotten ourselves into, and that we're you know, a pioneer in the space, and that has some good aspects to it and some bad aspects to it, right? And so you know, we have put a tremendous amount of time into getting to know the eco space. And we have tremendous reach into that eco space. Everybody knows who we are, right? And that's, I'm not doing that for my own ego, it's just a fact. And so when, you know, in May and June, we were able to literally get the risk management teams of all of the major exchanges, the institutional regulated ones that most of our managers deal with, get them on the phone. And they were more than willing to get on the phone with us because they know who we are. We're in the play in the space, and that we, you know, we matter, right, to the ecosystem. And they very much appreciate that. And these organizations will go out of their way to help us in that regard. And so that's one added thing that our involvement in the space is really, you know, we can get anybody we want on the phone, except for SPF, which tells you everything you need to know, right? I think maybe, but if, you know, we can dig deep into these organizations and get to the people that we think we need to talk to. And that process is constantly ongoing. And we attend a lot of events we go to events where we get to talk and sit and actually discuss with founders of these technologies and things like that. And so you know, it's really been quite a journey. I've learned a lot. And you know, so that, you know, I think hopefully some people take a lot of comfort in that. Just to sort of get back to the rebalancing issue, that it's tricky. And it's tricky not just in this space. So right now, we can tell you because we have a lot of network contacts with a lot of other CIOs out there that run asset pools. It's a really challenging environment right now because everybody has private assets, right? They are typically a little slower to mark down than the public market comps, right? And we've been in an environment where all the asset classes have been highly correlated. Okay, so and usually you could, you know, rely on if your equity went down, your bond went up. And the way that we work is actually we have equal risk in both, so we kind of offset them, right? In this environment, both are going down, right? But that's affecting everybody's portfolios, and so you have outsized private positions, and you've got asset classes that typically you would try to be rebalancing into right now. right? Because they're down, but you can't, right? And it's exacerbated by the fact that the private market firms, there's going to be no realizations in your private equity portfolio for a while, right? Even in your private credit portfolios, there's probably a reason to kick the deal down, kick that can down the road a little bit until you can get to probably a better environment where you can have a realization, right? The real asset stuff is throwing off cash, which helps, but it's not a liquid, it's not, you don't want to go out and have to sell rail cars, right? And you don't really want to, because that's a really steady income stream. So you've got this situation where you should be rebalancing to one thing you can't, and then there's lots of opportunity for private managers out there, so they're making capital calls at the same time. And so, it's created this dynamic. It's putting a lot of pressure on just how you manage the risk and how you manage that liquidity in your portfolio. It's challenging everybody. We're subject to it, but so that's one problem. We did have, like, some of our first couple funds, we had incredibly outsized returns. I mean, we're talking like really big, right? And so then, what do you do about that? Right? There's some portfolio construction things that we could do. Maybe we could, short some Russell 2000 futures against that, but that opens up sort of a whole bunch of sort of risk management challenges in itself. So it has been a problem. Again, some problems are first world problems and some aren't, and that's a first world problem, but it's a problem nonetheless.
My grasshopper to buy my exposure from
Yeah, I mean, there was solutions out there, but we didn't get them.
All right, so you weren't. I get it.
Well,
No,
sorry,
we
I
have
want to
some-
make one last comment, because also specific to the blockchain space, these venture capital managers. So I mean, it's a great environment, especially for any private strategy, right? Valuations are very low, so we're getting capital calls across the board, not using blockchain technology, and that's to be expected, and very low weight distributions. And but what we are seeing specific to blockchain is that the managers are coming to market with their next fund like 6 months after the prior vintage, or 10 months after the prior vintage, or 12 months. And historically, or typically in the private equity space, so you might think like 2 years, 3 years, right? But this has nothing to do with 2022. I'm talking about even like the couple years leading up to this, that literally managers are like 6 months later, like we're raising our next fund. Great. Meanwhile, you haven't gotten any distributions from their prior funds, right? So you want to re-up with that manager because you want to maintain that exposure, and you also want to maintain the capacity and the relationship with that manager. But you're having to fund those capital calls from somewhere else because you haven't gotten distributions from that manager's prior fund. So, and it just seems to be like everything in this space, to me, it seems like it's really super accelerated versus other parts of our portfolio.
In terms of sleep, our job is not to sleep at night, so everybody else can. It's part of the job.
All right, Ben, over to you. All right, so Katherine and Andy, I would say very progressive with respect to getting involved in this space as an institutional investor in 2018. What is keeping other institutions from getting into this space from your perspective?
I think first and foremost, honestly, is a lack of education and understanding what the space is all about. So maybe it makes sense to just take a step back to explain to everyone in the audience here and whoever's watching, the profound opportunity that presented before us with regards to blockchain technologies. Most of this conversation has been centered around, investment strategies and how to make money from a capital markets perspective. But we should also appreciate at the end of the day that the profound impact of this technology on the global economy, quite honestly, is going to be pretty pronounced over the next few years. Yes, we have examples that Andy mentioned before of just monumental changes to financial services with how blockchains can make things more efficient in terms of recording of transactions. But I'd probably say, more importantly, the real world impact that we're seeing now is there's an example of cattle farmers in Wyoming that are tracking their cattle on a blockchain, right? And there are healthcare examples coming out now through insurance companies where they're able to track each one of our own individual, health records through blockchains privately, of course. And so if you think about all that at the end of the day, I guess the point I'm trying to make is that that the way we should consider the industry is really one that's going to not only have impact with regard to the way we operate our lives every day, but more importantly, the ability to be part of that through investment. Now, the other thing I probably would like to say too is the fact that As we get more involved in this space and this recurring theme here with regard to some of the risks that are involved with going into this space, we have to, again, be aware of who the players are, like I mentioned before, and also really understand how we, as potential investors and our partners and all these things, are able to put pressure on the industry to conform.
One thing I would add on this front is that there was a lot of discussion and work evaluation taking place in other plan sponsors and other organizations behind the scenes. And because we are kind of where we are contacted all the time by people that want to ask these same questions. How did you get it? How did you get on this journey? How did you get it to the board? How did you do the due diligence? And so we talked to working groups, from large state plans, family offices, endowments, foundations. And when we go to a lot of CIO retreats where we interact with our peers, we can sit there and you said, how many people have it in your portfolio? Maybe one or two other people put their hands up. How many people have it in their own portfolio? They all put their hands up. Okay. And I would say that there's when we interact with all these people all the time, and that part of they're becoming a bigger part of the ecosystem, is that there's a lot of people that are reviewing this, trying to figure out how to do it. Texas Teachers is one group that we've known for a little while. They've recently made allocations for them, very tiny, but equivalent to ours in sort of a dollar sizing, in terms of and then putting that out to work. So they're in the process of making allocations now, and so it's growing, it's happening, and it's certainly there's a lot going on behind the scenes. You're just not going to see that. And I think that there's a lot of good reasons to stay out of it. But that is changing, and something like FTX is probably not going to speed that up, but the opposite. But it's not going to stop it. It's happening, so it's just a matter of time.
And Toby, just to that point, and maybe to just kind of circle around back to the question again, I think that's how we're getting comfort for investors, is showing them that we as intermediaries, right, are kind of doing our due diligence, but also more importantly, being kind of the front face with regard to institutionalizing and improving these things that otherwise we cause a lot of these risks. And then more importantly, I probably add that if at the end of the day, we're able to show whether it's large institutions like pensions or even kind of your mom and pop investor, that one, there's an investment case, as I just mentioned before, to invest in the area, but two, that there's maturation going on there. I think that'll lends itself to quelling a lot of the concerns and fears.
I would say one more thing about, I think what I to kind of have biases, but what might be keeping institutions away. We've talked about self-custody and some of the upper surveillance issues and volatility, and to some degree some of the lack of clarity on the regulatory front. But and I don't mean to be too general here, but often the people, the person or people that might be approving these investments. I mean, I'm going to generalize, but probably easily are, I'm going to say 15 to 20 years older than a lot of the people that they are investing in. So we have one manager, and the entire organization, there's only two people who are over 30 years old. And there are people, I mean, flip the entire thing. And this is actually a very well-known manager. It's not like whatever, it's a very well-known manager. They've been in business for a while, actually. And there's two people who are over 30, and one is like literally 32 and one is 34. So, and then we talked to another manager, very, very well-known manager. That manager, I guess like a lot of people, they went, hybrid during COVID. Well, they just gave up their headquarters completely. So there is no office to go visit. Yeah. So when you want to go on site, do your on-site due diligence, well, just turn on your camera, because there is no office anymore, right? And so, traditional allocators who were, have to, well, I did this, and check the boxes. Those boxes are different in this space, and that's just another thing that you have a lot of. Again, I'm being super, anyway, but you have people that be with the gray hair who are approving the investments, and the investment they're approving are people who might be, 25 years old, right? And it's, and these organizations haven't been around 10 years and 30 years, like a lot of other asset managers might have been, right? So it's again, as I said before, like, we just have to be a little bit open-minded.
No, it's a great perspective, but I would say from my point of view, it's very much a win, not an if story. You have firms like Fidelity who have been active in this space for quite some time. Had a lot of headlines recently about BlackRock getting into the space. I can tell you asset managers' phones are ringing off the hook, asking for exposure to their client and institutional business for this asset class. And, many of them are building those capabilities, but they don't have them yet. And what's accelerating this is when, the private wealth guys have to tell their clients to go open a Coinbase account. Like, that's not good, right? And so I can tell you just, again, from my experience that, many of the traditional shops out there that we all know as household names are absolutely building the space. I think we've got a minute or two before we open up for questions. I guess last question, and I'm very curious in this. So Katherine, Andy, having been in this space for a while, what would you do differently now than kind of what you did as you ramped up into the space, or maybe what kind of advice would you give to other investors who are looking to get into the space and start?
Can't wait to hear Katherine.
So I wish that I had pressed some of our managers to buy some of their, buy them or buy a portion of their management company, right? But I mean, I don't mean to say it that flippantly, but I actually, that would be great. And if we had some of it, the managers. But otherwise, I don't think there's anything that I would do differently. I've been really happy about how we thought about it and how we've approached it. And I think for people who have no exposure though, and who are looking to get in, I think fund of funds, and I know that once put together, fund of funds is a pretty easy first step, if you will, and you can get exposure to a broad number of managers and a broad number of underlying strategies. And so I think that in the fund of fund space, I think that we will definitely see inflows. But in general, I think I've been very happy with how we've gone about it.
Yeah, I mean, I don't know what I would do. I think the timing is good. We do have in some of the venture capital funds, they have opportunities to do some with tokens. And so on the cost basis, it's like 1,000 the Bitcoin exposure we have. I think we've helped fund some of the index funds with Bitwise, as well as so the timing on that was really good, and so we do have we've had a very positive experience. We're still having I guess the one thing that's been a challenge is just public perception. We get a lot of for better or for worse, we've become sort of poster child. Yeah. And so we've gotten a lot of input. Some of it has been a little tough to read and think about, but we've been very proactive. And when we get a call from a reporter, we will engage that person and make sure that they understand everything that we've talked to you about today. And more often than not, the story dies because the angle of the story was how much money have you lost? And when they understand that we're tens to hundreds of $1 million ahead, that goes away, right? And because it's not a story anymore. Okay. And so, certainly, citizens groups and things like that. We'll have our way to sort of explain this. It's not about Bitcoin. It's not, it's about technology. There's a lot going on here that is worthy of our attention and our dollars in a prudent fashion. So that, that's been a challenge, not just for us, but I think this, just in general, we did not set up to handle those kinds of things very well. So, and so that's been a bit of a challenge, but the extent, but I've never shied away from a conversation with anybody in that regard, because a lot of what you get is just, an opinion, not a set of facts. And so then you just have to get in front of that person the extent to which you can and present them with the facts. And generally it's just, that's it. So, but and I understand people's concerns, and there's a lot of buzz and there's a lot of noise, and and I had that perception too. So it's not that I don't get it. But I think we've been as prudent as we can be now. pitfalls, is there gonna be situations, no doubt, we've gone through some of those, right? But, everybody's like, have you changed your mind? Like, the answer is 15 years from now, will more things be digitized than not? The answer is obvious. So, and this is a long-term project for us, right? These funds that we're in, these venture capital funds, they have lifetimes of 10 to 12 years, not longer. We're 4 years in, right? We're the newest one that we just added, earlier January, right? So, we've got a long way to go in this, and that's what we're investing in. There's any Bitcoin, Maximus here or whatever you're supposed to call it. This is not what we're in it for, right? And maybe it's digital gold, maybe it's not. We don't have that view at all. It's just not something we even look at or subscribe. Right? It's technology, and that's all it's about. And if you can get that message out, it's easier. But I'll be honest with you, it's not been fun. But other than that, everything has been, other than people putting your head on the pitchfork, you're putting their.
Well, I think your comments right there are great guidance and advice, and that is to have a very sound strategy with respect to the exposure, which you all clearly do and have put a lot of thought into, very thoughtful, but just as important to be able to articulate, which you all do very well. So, I mean, that is probably table stakes in a minimum for any type of investment decision, but certainly one where, it's controversial and it's kind of a digital essence. Perfect. All right, I think, yeah, let's open it up for questions. Yeah, by all means. John, how do we want to do it? Do we want to do this in here, online? Do we want to do this?
You can do it here, and we'll start here, and then even if there's any online, take them. Let's start here.
Yeah, perfect. Yeah.
Do you think that the institutional search process is what's broken? The RFP, the manager search, is that part of the problem that institutions are having because of the way that they're kind of programmed and the way they're kind of database kind of centric done the searches?
People have a certain way of doing things and based on experience, and I think that is part of it. I would also say, and I don't mean this disrespectfully, but I think kind of the average investment consultant, who wants to see kind of the typical 3-year track record, and that has kept a lot of institutions on the side, and I think that will change. And there are a couple of consultants, by the way, that I think are very ahead of the curve, and so I put Alborn in there, and I would put Cambridge in there as well. And I'll stop with this too. But so I think there's a couple of organizations that are very ahead of the curve, but I think on the whole, as a whole, I think that has kept some institutions on the side. And I do think people are going to have to change the way they do due diligence on this space, because it's just so important.
Hi, thanks. I love the example you gave about Wyoming and the cattle, but it's also because Wyoming has very solid infrastructure and process around how to work with digital assets. They're one of the first to pass law in this nation. And I'm wondering how you feel about having more infrastructure and guidance and protections on that level to be able to guide through things, to protect things, to support things, to elevate the conversation, and to perhaps even begin to shift some perspectives about digital currency and its value.
Yeah, well, I mean, this event sort of was brought to us by the Economic Development Authority here that's interested in fostering an environment in Fairfax County, along those regards, right? Some places are much more advanced, Texas, Miami, French and Wyoming, and so I think the more people that get it, that will continue to grow. We would welcome and look for more regulation in the space. And I think that's going to be one of the outfalls of this. Hopefully it's just not reactionary, but just thoughtful. And there's a lot of people that, we've met a senator from Wyoming that's working on different, initiatives in Congress. And so, I think that's going to continue to grow. I don't know what gets it there. I don't think this helps, but it may, and hopefully it doesn't speed up regulation and involvement in a haphazard way, in a thoughtful way. But yeah, I mean, Wyoming is a great example, and I think obviously the folks at the Economic Development Authority have that thought process in mind. And I know these folks here The blockchain, different blockchain associations are very active in this space. I will say, I don't know that it's, there's a lot of push for regulation. My own perspective is, I don't know that some of the regulators have been facilitated that. There's a lot of, sort of mixed messages that are coming out of certain regulatory bodies that is probably not helpful either. So, but yeah, let's open that Pandora's box.
Yeah, I mean, I would add to this.
Yeah, you know much more.
To get more and more institutional adoption, we need to have more visibility from a regulatory standpoint. And it's as simple as things like SEC, CFTC. What is a security? What is not? I mean, that's a question that the industry's been asking for 6 years.
And the answer is not coming from the regulators. They're busy
It's,
fighting.
we still don't have an answer. That's right. And it seems like a little bit of a turf war. But those are the things that our organization is pushing for, is to create dialogue around that. And at a minimum, just create some visibility and transparency so that organizations know what the rules are and how they can operate. We've been in kind of this, regulation by enforcement environment for several years now, and that's certainly not productive. And it's, not bringing more people to the table. It's giving people more pause.
Can I add to, we shouldn't just put the financial regulators like the SEC or the CFTC on the hook. There is also the IRS. They're not particularly clear with how you are going to charge taxes for a lot of these investments. It's a constant conversation we're having amongst ourselves and with our clients. And then the other element I would add there too is, from the perspective of also considering regulation with regard to marketing. That's not particularly clear right now. That's something else that I think a lot of emerging crypto businesses are trying to figure out, is how they put this stuff out there with regard to branding. And again, if you're a financial services business, what can you say? What can't you say? What is a security? What is not a security? And the other group that I would put on the hook as well is the audit industry. They too are not making absolutely clear what they consider to be the standards of pricing and valuing these assets, which is again, slowing down the process for a lot of us to be able to move on to, again, as an industry, put together funds and portfolios. So both institutions and eventually the general public can invest a lot more. If those are not cleared, all those areas that I just mentioned, then we're in this constant stasis where we're not moving forward.
Agreed.
Staying in the regulatory space, would love to hear your perspectives from the institutional aspect, and then Vincent, yours from more of an individual retail perspective. So if financial regulation at the federal level comes to fruition, bringing more of the traditional finance regulations with it, how might that impact the yield farming investments? The fact that some of the investments you have are probably self-custodying assets when it should be third party technically. And then I guess from your perspective, from the personal investment side, when exchanges like FTXs have to be regulated and so forth, and then also possibly how does self-custody play into this? So I know that was a lot there, but
I can sort of touch on the yield farm. So we think those, if you get more regulation, certainly more money coming, those yields are going to go away. Like the yield farming strategies that we're in are essentially money market instruments, but they're in crypto space. I don't like the word crypto, so I'm going to say digital space. Okay. And so they're money market type instruments, but they're earning outsized yields because it's in that environment, right? And so those types of opportunities will go away, but they're going to exist, and that's kind of why we think it's a good space to get into, because again, there's lots of challenges out there to fund these pension systems. And so it's just a little way that we can add a little bit of incremental return. And but that's going to get that'll get compressed. Those yields will get compressed. And that's fine. We built that into our expectations. I don't know how long it's going to take, but maybe it's 3 years, 5 years. It could be 18 months. So that's just that. I'll let everybody else do the rest.
So I guess I want to focus in on what you had a question about from the custody perspective. Again, an ongoing theme here. My answer will cover both institutions and individuals. I've been doing a lot of thinking about this over the past few weeks with regard to FTX, and I think we have to adjust our expectations to Andy's point, new technology, new paradigm in terms of what we should expect with regards to custody. I wrote a piece about this a few months ago, obviously not knowing what was going to happen, about where did custody come from, right? And it had to do with pensions failing and removing those assets and putting it with a third party. If you think about the example that happened over the past week, right? People entrusted their assets, their holdings with a third party that for all intents and purposes misappropriated it, now is also disappearing. My point there is that maybe we need to consider in the world of crypto and digital assets that maybe self-custody is not the worst thing. However, having controls around that. It's really hard to get money out of a bank these days, right? You know, old school fashioned robbers gone away about 100 years ago. And anyone that did financial crimes, well, there are so many layers of controls and regulation and technology in place. It's not impossible to do, but it's really tough, right? And that makes sense for traditional assets. I'm arguing now that maybe we need to consider that for crypto assets. Maybe the best place to keep it is with yourself. Although a lot of us had said before this meeting started, the problem is if you lose your password or your keys, you're in trouble, you're not seeing your assets anymore. But if you're able to control your own assets because they're held in a technology such as a digital wallet, right? And maybe there's some other intermediary there that could prevent someone from getting in there to commit fraud. Maybe that's the way we need to consider this going forward.
I'll pile on there. I think so. A lot of the rules and regulations in the financial services capital market space are from, I think it's the Uniform Commercial Code, which is from the 1950s. Like, we're not in the 1950s anymore. This technology solves for so many things that many of the rules were put in place. And so, it's kind of like square peg, round hole, it feels like to me. So, we need to come to the table and create new regulation, new laws that match the capabilities of technology.
I just want to add one more example too, having been doing this for quite some time. There was one word that came out of the Lehman Brothers debacle that most people didn't hear about within the industry, and that was rehypothecation, right? Where a bank is able to take the assets you give to them and give it to this one and give it to that one, and then when it all blows up, you have to figure out a way to unwind it, right? And so what I'm saying there is that, again, going back to this argument as to why we need to rethink about who actually holds an individual or institution's assets and custody it. You're not doing rehypothecation when you're controlling that account. If you're putting it with some centralized counterparty, be it based in the Bahamas or anywhere else, you don't know what they're doing with those assets, right? So just something to consider.
Yeah, I had a comment and then I guess I went into a question. My comment was when you talk about Bernie Madoff. When my friends asked me about SBF and FTX, the debacle, I compared it to Bernie Madoff, and I tried to explain to them that, Bernie Madoff had gotten to such stature and influence as being chair of NASDAQ and being on the advisory committee of the SEC. When they asked him about SBF, he had gone to such influence of being the second largest Democratic donor to the recent midterm. When these bad actors get to such influence, because they're scammers, you can't avoid it. And so it goes back to the question of what was the principle behind like crypto is decentralization, right? So here we are slammed again with the same message. It's like either you have custody or you don't. If you don't have custody, even if you give custody to a Bernie Madoff who's sitting on the SEC advisory board, SBF potentially having some kind of relationship with the SEC chair now. I mean, these are unavoidable, and if they lie, they lie. And you're not going to be able to see it all the time. Millions of people didn't, right? And people who should have known better didn't. So how are we supposed to know things that they didn't see? But it's because everyone's chasing yield, right? So my question is if we're in this space because we believe in the principle of technology, that goes hand in hand with decentralization. So in your organization, are you holding custody of your assets, or are you going to any kind of centralized portal, platform, exchange? And so if you can't trust any exchange, no matter how big they are, how many people, they have invested in them, including governments, right? Including governments. If you can't trust that, if there are options, because we have the technology to go with a decentralized platform, which are out there, why don't we go to them? And because we have smart contracts, you don't have to be the only signature, right? All the technology is there screaming for everyone to go decentralized versus relying on a centralized party. And so does Bitwise, do you hold custody? Have you gone decentralized? To a different protocol? But you're gonna always be, no matter how much you have. Then put it on a smart contract where you have multiple signatures. And this way, a fail safe, if someone loses the private key, there's lots of ways to avoid this in the future. And I think we'll have another bad actor coming, right? Because like you said, it's a very nascent space. And most of these people are 20 something. You're gonna have more SBFs finally to political stature, Bernie Madoff sitting on the SEC. I mean, it's unavoidable.
Okay, so I think there's three parts to what you're asking. I'm gonna take it piece by piece. One, with regard to the technology and smart contracts, you're absolutely right. Unfortunately, the industry, one very key player, was not really implementing using the very technology that they claim that they were part of, right? And I would say that, when it comes to the specifics of centralized finance and smart contracts, that is the utility of the function of it, is that you're not supposed to have to be reliant on anybody. That the technology is there, and if you want to go on chain to see who the parties are involved, how they're going to transact with each other, how a contract ends, it should all be there. But again, a lot of people are obviously not practicing what they preach. Second part, with regard to my firm, we are quite conservative, first and foremost, as one of many people now that conduct counterparty due diligence at my organization. We are kind of take the philosophy of trust but verify. So as I mentioned before, I'm not worried about personalities, although that is a factor that we consider whether or not there's a risk there. We're going within the infrastructure of the organizations we're talking to, ask them to provide their audits to us. If they're doing any kind of control reports or something called a SOC report or SAE, where a third party comes in and tests system technology, we're going through all that. And then we're also going to, conducting a counterparty verification and due diligence process that we're keeping an eye on everyone going back. All that to say, for our assets, what we do is we move things to cold storage. If it doesn't need to be in the market, we're taking it right off because we're going to be a fiduciary and be responsible with our clients' assets. And then I guess the third thing that you were asking there too is really this idea and its elements, again, from a regulatory perspective, how do you trust governments and all that other stuff? Well, unfortunately, as I mentioned before, we can only really work within the bounds of the regulation that's presented before us. But I think to a common theme that's been discussed here today, I think, and Andy had mentioned this too, the regulators really need to get on this already. Their hesitation, I'm not going to blame them for what's happened over the past few weeks, but their hesitation for sure is stopping really, an emerging industry from realizing its full potential.
Any questions in the room?
I can't see you guys. My question's regarding institutional adoption. You guys touched on a little bit. And I'm curious from where you sit, if you actually have seen in the past year and a half more broad institutional adoption. I guess anecdotally, it makes sense to name this. Came from Cambridge, worked with Joe Miranda on like all the blockchain diligence, things like that. And over the past year and a half, did not really see as much as I think we anticipated. Obviously, back in May and earlier this year with the whole Luna debacle with Riveros, there was a lot of erosion of trust. And now this, and now I'm currently on the fund side, and we're kind of as we're fundraising, the only real kind of traction we're seeing is within the family office kind of sector of things. And you all are pioneers. And so I guess my question to you is, one, is that broader institutional adoption with pensions, foundations, endowments, et cetera, actually happening at, a pretty sustainable rate? And two, are you all actively kind of engaging with them to like kind of, because I agree with what you said earlier about the educational component, particularly with LPs, like that's, I think, the biggest gap that we're missing in a lot of ways. And is that something that you are actively engaging in dialogue with other institutions to kind of move the space forward?
So I'll start. So I mean, my information is probably anecdotal at best. So if you came out of Cambridge, you probably have better statistics. So, we know of people like, we go back to Texas teachers and they, but they're one of the other, like you could count them on one hand. I feel like these public pensions that are now, become active, if you will. I think the endowment space, my sense is that they've been active for a while. So, but, I mean, I actually presented at another public pensions board meeting on this topic like 2 years ago during COVID. But again, it's just anecdotal. So yes, we talk to people regularly. I mean, we have other, we're both generalists, right? We both manage dollar pension. It's not the only investments that we have. So we're not 100% of our time doing crypto and digital asset related things. So I don't spend all my time talking to other people about this. But yes, we do talk regularly to the people and we attend conferences and I speak on panels on this topic a lot. So people hear me speak and they hear my comments and they get in touch with me. And so we do talk to a lot of people, but I mean, I think you made the point yourself. I think that like the Terra Luna debacles of the summer reserves capital, I don't think that helps the public and public messaging, if you will. Certainly the FTX experience. Now, I mean, I think Ben made a great point. Like this has happened into the traditional finance space now. This isn't specific to crypto per se. You had a conflict of interest, right? Where you had, a prop trading firm and an exchange, and that's, those somebody's conflicted, and it was the same way with Bernie Madoff, right? And anyway, I mean, we have to talk about Bernie Madoff, but I'm happy to talk more about Bernie Madoff on the way. So, but anyway, so I don't know. I mean, I think it's anecdotal, but I mean, I think people are definitely interested in, like, my experience has been the people that have reached out to me that are really interested, and I know I get back to all these biases, but it's like the 30-something-year-old in an organization, and so it's not even like this is going before an investment committee. That person, that individual, is just trying to get buy-in internally, like amongst the investment committee, and then it will go to like but that person is just or amongst the investment team, and that person themselves is like personally super interested in the space. They personally are invested. They're trying to get their colleagues like up to speed and also interested in the space. Their colleague is, I'm going to say 15 to 50 years older than they are and isn't as, into the, anyway. So, but I mean, I think we'll get there, but I mean, I think it's slow and these bumpy rides don't help that.
I mean, it's definitely out there, like you mentioned, like we know a lot of these folks that are either working on it or have started moving in that way. We were at the census in Austin, and they have put together a whole day allocators to spend on the topic together. It was a room that wasn't big enough to hold all the people who were in it. Okay, it was pretty hot and stuffy, but I mean, it was, there's a sizable community out there, very reputable, institutions and institutional investors out there that are taking baby steps or are looking at it. Like I said, this past week doesn't happen, right? So I don't, would they have invested, a year from now? Maybe it's 2 years from now. So I don't, I don't know how to gauge that, but that's going to be the net result, unfortunately. So.
Thank you. Any questions on the line?
We had one question online. Do you see investing in quantum ready cybersecurity solutions as a way to hedge your investments in life?
Let me just start out by saying, like, as I mentioned, like, when we started this, one of these verticals of innovation, one is blockchain technology, but one is also cyber and national security technologies. I don't necessarily consider it a hedge per se, but we definitely think it's just another area of tremendous growth and promise, if you will. So, but it is funny. I mean, I've been asked that question before about quantum computing, and I don't know that I have a great response, but we think it's just also an area that we want to be invested in, not specifically as a hedge, but.
So, I follow quantum computing because it's the next step, and in theory, and this is public, what we know is cryptocurrencies, which is cryptographic coding, could essentially be unwound because of the capabilities of quantum computing. I don't think we're there yet, at least from a commercial perspective. Who knows what certain governments may have right now, but my answer is this. I've been seeing enough self-development within the firms that we work with, and then creating really profound cybersecurity technology related to how they go into the market. Again, smart contracts is an example of that. There's firms that I've come across that essentially create something like almost like an internet spider web crawler that's able to go through your entire blockchain to see if there's any weaknesses. I think right now in the immediacy, there's enough technology being developed from a cybersecurity perspective to keep crypto safe for quite a long time. Maybe in 20 years we'll have to worry about what the quantum computers could do. But right now, I'm not seeing that really have an impact. I think the players in the space know where the weaknesses are, and they're putting, at least from my perspective, a lot of the good controls and safeguards in place to make sure that everything's protected.
I think I saw one more question in the room, and then I think we'll wrap up.
Just a question just around beta allocation, whether, I'm assuming you allocate beta to the traditional assets like stocks. How do you think about kind of a 70 to 90 ball asset, and is it 10 years out, or what's your thought process?
Yeah, so just the way that we model it, most of our venture capital, the underlying beta, right, is say a small cap growth index type volatility, which is, it's about 22. So that's the base, right? But then we assign a pretty big tracking there for that, right? So something in the 30 to 35% range, right? And so far investments we've developed cone charts every. So this is our expected return. It's no volatility, and then we understand it's going to be volatile. So what's the bracket around that? What's the range around that? And it's tracked pretty much inside of that so far. So and so it's like, I don't want to get into too specifics because I don't want to sort of managers, but that's just sort of how we think about it. Is that there's a beta to it, right? But then there's a big idiosyncratic to depending on what we're investing in. So we would assign with blockchain something way higher than say late stage growth equity, right?
I was thinking, sorry to interrupt, but I guess I was thinking along the lines of a spot Bitcoin ETF, like that kind of allocation. Is that not conceivable from where you guys sit now?
We would never do that.
No.
I mean, we own, again, some of the funds that we can own liquid tokens, and so we seeded with Bitwise index funds. So we own some Bitcoin, but that's not the investment thesis for us, right? And so, and it's masked a little bit because most of these things are inside of our quarterly value fund, right? So what's going on right now, we're not going to see till February. And so but and then that helps a little. We don't, but it's not something that we just then take for granted. We're looking at the underlying economic, but to us it's just technology. And so we would never own just a flat out Bitcoin position.
For what it's worth, I work at Bitwise. We have a correlation calculator on our webpage where you can look at like on a 1, 3, 5, 10-year basis what BITW, the crypto index, which is 60% Bitcoin, 30% ETH, et cetera, than some of the smaller coins. You can see what that does from a risk return profile over a certain period of time with like a customized portfolio of your own kind of selection.
Again, it's part of our process. We got to figure out what that is first before we do anything, right? So, and we've given it, it's as much art as it is science. We've given it a pretty wide berth. So, and I don't think, I don't know that estimation has been that far off. I mean, I would just say Bitcoin's probably what, 100 ball or something like that. And it's down 70% this year. So it's not even like a one standard deviation event, right? Whereas like, you try to explain this to people like, we've taken lots of losses in US government bonds this year, right? The 30-year bond has had like a 4 standard deviation event. Like on a risk adjusted basis, Bitcoin's way ahead.
Bonds have been much more volatile than Bitcoin.
So like,
relative to what
that's, you gotta have that, you gotta be able to sort of think about that, but the noise will stop doing that, right? That's our starting point. So.
Katherine, Ben, Andy, thank you all so much. John,
So I'm John Gustavo Blair, and for those of you who are interested in quantum, we do have a Quantum World Congress at the end of the month. Sponsored for DC, so just go to their website and find out more information. So I'm the assistant director of national business investment at the Fairfax County EDA, and really want to thank everyone here for attending the event. The expertise that was shared, and we're proud to have Fairfax County here and the pension funds to support investment in blockchain technologies, and also to have all these folks come from out of town, including Bitwise and Toby, and the support through many years of the Chamber of Digital Commerce. And the new support that we've developed with Virginia Blockchain Council, Connor and Greg and all the people that we brought, and we're building a closer relationship with you all. So just a brief introduction to what we do. We're Fairfax County Economic Development Authority. We help companies with resources, whether they're here in Fairfax County or looking to expand into the area, helping you find office space, connecting with incentives, talent acquisition, also communications. And we also want to disseminate different ideas and communications and be a participant in the ecosystem of technology. So that's why we have events like this, the Quantum World Congress, and other events throughout the year. So for all you attending in person, there's going to be coffee and tea, and really appreciate everyone else attending online. And the event has been recorded, and the link will be sent to attendees. So all attendees here will get that link. If you wanted to see and go over all the great content that was shared today, you can do so. So thanks very much. I appreciate it.